After the bankruptcy of Tricolor and then the bankruptcy of First Brands and then a whole bunch of other concerning signals along beside those, markets are starting to get uneasy about the state of credit, especially private credit, in the US dollar system. Even the stock market is starting to catch on that maybe there's something there beside just an idiosyncratic story down in Dallas, Texas with Tricolor. The subprime auto lender shocked a lot of people, not just with their Chapter 7 liquidation and what a surprise that was, but it kind of opened the books to give us a little insight into what's been going on deep down in these shadows. And so the stock market for a lot of private credit companies, have we seen their stocks being sold pretty sharply, whether it be Ally Financial, which is a big one, Bread Financial, Affirm Holdings, even Capital One saw its stock price down by about 7%. And during a period when stocks overall are just continuing to soar, especially anything related to AI and technology. So it might just be a blip on the surface. And it also might be rising concerns that there really is something to be concerned about, especially when you put together these two ingredients, the opacity in these private credit spaces, along with a macroeconomic climate that is much worse than people are willing to concede. We can already see that in the labor market, and it will be the labor market that ends up directing how everything goes here. And I think that's what the stock market even, is starting to sense. So Steve Van Meter, we've been talking about credit market cracks to begin with, and there's a lot of other stories beside. I mean, we haven't even talked about, one of your favorite topics, vendor financing and short-term financing from all of these companies. So you've got subprime autos. That's the one that everybody's talking about, but it goes way beyond just subprime autos.
Yeah, Jeff, because this starts to look a lot like the financial crisis. The housing market was booming, the stock market was booming, the economy was booming. And yeah, this started to show some cracks in the subprime housing market. And everyone just said, oh, well, it's subprime. What do you expect? Of course, things are going to go wrong. But what happened, and after this, is a lot of the banks started taking a peek at what they were actually doing and lending to. And they started to realize that, wait a minute, maybe this just isn't isolated to Tricolor. And now it's what we're starting to see in the market with some of these stocks tied to these companies start to drop, is because everyone's wondering is this literally just an isolated incident, or is it really a sign of stress in the financial system that a lot of lower income workers are falling more and more behind? They're getting fewer hours, they're losing their job, and all of these auto loans are going to start blowing up. I think that's what we're starting to see in some of these stock prices.
Yeah, the macroeconomic component is the strongest one here because that's the predictor for all of this, right? If you have a job, chances are you're going to pay your debt. I mean, that's the way most people operate. If you don't have your job, or even if you're just worried you might not have a job, maybe you skip a couple of payments that you don't necessarily want to skip, but you have to do it anyway. And so the macroeconomy really starts to become the driving factor behind what you said, Steve. Everybody starts to take a second look. Even the big banks like JP Morgan, they say, Tricolor, we know they lend to, the least optimal borrowers, but, the economy's generally fine. Jay Powell says it's steady. There's going to be rate cuts coming, so everybody's going to be great. We're not going to really worry too much about it. But then suddenly it blows up, and now they're not just re-examining their assumptions with Tricolor. They're thinking, who else should I probably go and look at? Because this really wasn't about the fraud that everybody's talking about. There's definitely something more going on here. And I think that's what's got people's ear, is that, look, there was a lot of bad assumptions that went into it, just like any other bubble. Like you said, Steve, 2008, the bubble that goes on there, the bubble that went on there, and the bubble that has happened over the last couple of years, it's just people get out, they lose control, they lose all inhibitions, and they start thinking things will be fine forever, so we can become riskier and riskier and riskier. And eventually that comes to a point where it just gets too far, and everybody says, so let's hold up here. And when they say hold up here, what they do is they go back and take a second look at everything they've done. And if they don't like what they see, especially given these macroeconomic conditions, that's when you start to see all of the negative second and third order effects. So that's, I think, what right now in the process, I think what we're seeing is everybody saying, whoa, hold up here. Let's start taking a second look. And because the markets have been saying this all along and hardly anyone has known it, that's why on Tuesday, October 14th at 6 p.m. Eastern Time, we're going to have a webinar where we're going to go over the hidden truth, the hidden secrets, the hidden knowledge and information that is in the interest rate market that economists and central bankers won't give you because they don't like what the markets have to say in that regard. The market, don't fight the Fed. The markets fight the Fed all the time. And we're talking about the vast majority of the markets too. That's what they've covered up. The fact that the vast majority of market participants deep down in the financial system and in the monetary system have behaved in a way that they don't like. Well, you need to decode that information, and it is increasingly clear why that's the case. But most important of all, we're not just interested in looking backwards. We're going to be looking forward and understanding these signals. So it's absolutely critical to understand the hidden truth behind interest rates, and that's what we're going to go into Tuesday, October 14th, 6 p.m. Eastern. There's a link in the description to sign up. It will be well worth your time to attend.
Yeah, absolutely, Jeff, because a lot of people again are brushing it off as an isolated incident, but you and I, we've been looking at the fact that the US economy has been slowing for quite a while now. And just because we don't have the non-farm payroll report today doesn't mean that the payroll market or the jobs market is expanding. We know it's continuing to slow. And that's what really this is an indication of underneath is the economy has not been working for a lot of Americans. As you say, of course, we forgot to how to grow an economy, but what we're seeing is continued stress of delinquencies starting out with low-income Americans. It's moving into the middle class. And we're even seeing some indicators where wealthier Americans are falling behind on their credit card and car payments. And again, everybody wants to brush this aside and say, well, look at the S&P, look at the NASDAQ, are all-time highs. This is no big deal. But again, we said the same thing as subprime housing started to fall apart. It's not a big deal. And then all of a sudden, it was a real sign that it was a big deal.
Yeah, it's like look at the NASDAQ and S&P, but then it's also, okay, within the stock market, you're seeing what's happening here with these private credit lenders or Ally Financial or Capital One. And it's, okay, here is the stock market saying, oh, wait a minute, let's hold up here. Let me read you what Bloomberg said this past week. Beneath the surface of what's been a remarkably resilient U.S. economy, which, by the way, that's just not true, a series of small shocks in the world of consumer credit have combined to rock companies that service the most financially vulnerable Americans. And of course, they're talking about subprime. Auto lender Ally Financial tumbled 13% during a 9-day losing streak. Fintech lenders, Upstart Holdings and Pagaya Technologies, they sank more than 20% in that same 9-day period. Digital payments company Affirm Holdings and lender Bread Financial, they suffered similar fates. Even Capital One, as I mentioned in the introduction, one of the nation's largest credit card issuers, lost 7%. So Bloomberg continues. Together, these events stoke concern that a key swath of American consumers is starting to buckle under the weight of tariffs, and they call it a slowing labor market. But let's be honest, the data shows that we're losing jobs. So it's not just a slowing labor market, it is a reversing labor market. So while high-end consumers continue to enjoy wage gains that fuel spending, worse off Americans have seen paychecks crimped as prices continue to rise and, of course, jobs continue to disappear. The threat now, and this is the whoa, let's hold up and see what's going on, is that the cracks in subprime credit will widen to more solid areas of the economy and usher in a downturn. Or really, it's the downturn that precipitates the revaluation in the credit, which is, I think, what we're seeing right now. The stock market is saying, let's hold up, let's see what we got here. And the reason the stock market is saying, let's hold up on Ally and all these other ones and Capital One, it's simply because they are taking a second look, and it's not just about subprime autos. They're taking a second look across all of these credit markets, and we'll get a better sense of what that looks like with the big bank earnings that are going to come out in a couple of weeks here, telling us what the big banks are seeing as far as loan charge-offs and delinquencies and all the credit statistics that we can get in the visible economy. And then we take that and think and apply that to the shadow banks and the shadow conduits and say, if this is what JP Morgan's reporting, what must it really be like over here? And that's where the stock market's saying, okay, let's sell a little bit of these shares and some of these companies because there's a good chance that we're not going to like what we see.
Yeah, Jeff. And on top of that, the market's saying, look, we figure the Fed's going to cut rates here, but rate cuts aren't going to fix this. And I think this is something people really don't understand is, yeah, I've got a loan and I'm delinquent on it. If the Fed cuts rate, it's not like somewhere magic money shows up and I'm like, oh gosh, my payment went down. No, for all these people, it makes absolutely no difference where the federal funds rate is because a lot of people are upside down and they're losing their jobs and losing their income. And that's why they're in delinquency. So you think about, hey, will the Fed cut rates and this all of a sudden the economy will turn around? No, that's what the market is saying with the stocks of these companies is rate cuts aren't going to fix this. And so you kind of mentioned that, yes, it's a slowdown that starts first, and then you start to see hours get cut, and then, of course, you see some layoffs, and the next thing you know, that stress just builds up underneath the system. A lot of people, of course, even Janet Yellen once famously said, we'll never see another financial crisis in her lifetime. But Jeff, this is exactly how financial crises start. You get a massive buildup, but the economy isn't growing fast enough to support all that debt. And next thing you get a slowdown. It doesn't even have to be a big one. It just has to start slowing down, and then the cracks start to form. Again, a lot of people want to just, look the other way at tricolor. The problem is when you look at the economy, see what's going on in tricolor is probably happening in a lot of other companies.
No question it's happening in a lot of companies. That's where everybody's starting to say, let's pause here and let's take a second look. I mean, you look at the actual labor market statistics, and what it says is that there is some transition going on here. Like I said, Steve, you're right. Lower interest payments are not going to help people that are losing their jobs, or a lower interest rate from the Federal Reserve is not going to help people who are afraid of losing their job. What are they going to do? If they're missing credit card payments or auto loan payments because they're worried that, they keep hearing their bosses say, we might have to let people go. The Fed lowering by a couple of quarter point increments is not going to get them to go back and say, oh, I better start paying my bills again. They're simply going to pull back because of the macroeconomic climate. And that's what drives the credit markets, not the other way around. It's not like the credit markets reverse and then that creates the recession. That's the 2008 crisis. That's not going to repeat again. What we have is the opposite, where the macroeconomic weakness is driving problems in the credit market, and then the problems in the credit market can definitely impact the macroeconomy. But that's what we got already, is a transition from an economy that was already suffering from lack of hiring to begin with. And so we went from no hiring and no firing to now all of the evidence suggesting the macroeconomy is no hiring and some firing. That's everything says that. I mean, whether it's the establishment survey, the JOLTS figures, which show negative net job turnover, ADP, which came out with its third monthly negative in the last 4 months. Even the establishment survey has a negative month on the board. So we've gone from no hiring and no firing to no hiring and some firing. And as we transition from no hiring and some firing to no hiring and more firing, that's going to negatively impact the credit market. So people who are looking at the macroeconomic situation in the labor market more honestly are going to take a second look at all of these lenders, not just the subprime auto lenders, but Steve, we talked about this before, credit card delinquencies among the lenders and providers that we already see. Credit card delinquencies have been moving up for the last couple of years, and this year they've gotten really high to the point that the relevant comparison is 2008. So we already see delinquencies, and another shove in the direction of more layoffs in the labor market. It's going to lead to even greater cracks across these credit providers. And again, the stock market of all places seems to be sniffing that out.
Yeah, Jeff, and when we're talking about delinquencies, and we can go back a couple of years and we can see kind of, I want to say late 2021, we finally start to see them rise. But there was another indicator, kind of probably one of my favorite indicators, is weekly hours worked. And, it starts to come back to the fact, as you said earlier, if people have the means, if they have their job and the income, they're going to pay their debt, because they're not buying a house to have someone take it away or a car to see it get repoed. They're buying it because they want to use it and enjoy it. And so as soon as we start to see hours worked decline, what happened? You see the delinquency rate rose. And now what are we seeing? The delinquency, at least we're hearing, is going to go higher, but we haven't seen, of course, we don't have official data now on the hours worked, but we can start to make some assumptions based on the Conference Board and University of Michigan, even from what we're hearing from Challenger Grand Christmas. We thought corporate layoffs were going to come down, and everyone said, okay, this is it. And all of a sudden it's like, well, maybe a few more are going to go. You can only assume that somewhere along the way, hours are dropping here. And that's why we're seeing this big rise in delinquency. It's not that people don't want to, they just don't have the means. And as you kind of said, as this continues to expand, it's going to get worse. And then it's going to be the credit markets that are going to further damage the economy. And next thing you know, the big question we're going to have is, how do you turn this thing around?
Yeah, you said something right there. They just don't have the means. And it's not just true of consumers, not just subprime borrowers, but also consumers. But it's also true of businesses, right? I mean, that's where this labor market weakness is coming from. They just don't have the means. They don't have business that's coming in, and they're being squeezed at the margins by tariff and other associated costs. So what they're saying is, look, we don't have the means to hire people and pay them to begin with. And one of the other things that we've been talking about, something you've been talking about, I know repeatedly, is the fact that a lot of these businesses that have been struggling have been as sort of a last ditch effort. They've been appealing to these short-term credit arrangements like from Slope. Here's another article. Slope, which is JP Morgan Chase's backup lending startup that arranged the short-term financing for a lot of people, says applications for its credit lines surged 730% year over year in August, which is, they blame this on tariffs. This is when it's clear that the importers from coming from Asia, that tariffs were going to be 50% on Chinese goods, and therefore they would be in place until the Chinese tariff situation actually settled out. And it's not just Slope. Dublin-based Wayflyer has extended credit to 5,000 clients, mostly small e-commerce firms, since its founding in 2019. And Chief Executive Officer Aidan Corbett says new loan applications in July jumped 28% from June, nearly triple the typical seasonal increase. Clearco extended 46% more loans to clients in July and August than it did in the same months of 2024. So you have consumers don't have the means because businesses don't have the means. And this is clear, absolutely clear late stage cycle behavior. It's when you're convinced that all you need is just a little bit of money to tide you over until everything picks back up again. Or in this case, I just need a little bit of extra funds to pay tariffs, and therefore I'll sell off the inventory over time and be able to pay back those loans. Classic late stage cycle behavior. And what these statistics are saying, along with what we're seeing from Tricolor and some of the other private credit sources, is that people are convinced they're moving to more extreme measures because they think things are going to turn around in the short run, when all the data says it's going in the wrong direction. So even the stock market, like I said, because parts of the stock market are picking up on this, but it's not just subprime autos. It is much broader than that.
Jeff, I don't think it's all about hoping things are going to turn around. I think businesses are getting to a point where they don't have an answer. Now, I was recently at a supply chain conference. My girlfriend actually works in lending in that space. And it's really interesting because I've told her, I said, I think there's going to be a huge boom in your business, because a lot of business right now, they're going to the banks, and the banks are saying, no way, we're not going to lend to you. Go over there. So they're pushing them into what, is called the shadow lenders. A lot of people think, they don't know what that means. They're just, off balance sheet lenders who are, loaning against, say, inventories or receivables or something. And you start to, when you talk to these business owners, you start to find out is they don't have the cash to keep running their business. They're out of money. Their bank won't lend them anymore. And they've got all of this inventory that they bought up thinking that someone might buy it. So what do you do when you have nothing else? You either go out of business or you leverage everything you can. This either is going to work out really well because they're going to get their money they need to stay in and the economy is going to turn around, or what we could be facing is a lot of shadow lenders, a lot of banks who lend against all these inventories, receivables, and whatever they've lent against are going to find out there's no buyers. And they're either going to get stuck with inventory or face massive defaults. Either way, I don't see this coming out as a winning play. But again, you just look like you said, what's happening to subprime autos. You're seeing everybody's getting desperate now. It's like, hey, where can I get money? Yes, I'll take it. What are the terms? Yeah, I don't even care. You just give me the money, because if I don't have it, I got to close my doors tomorrow.
That was the other big story, right, Steve? That was First Brands. So Tricolor, bankruptcy, subprime autos. First Brands was an auto supplier. So seems like it's in the same space, but really is a different story. First Brands had done exactly what Steve said. They factored all of their receivables. In fact, they loaned, basically enough out for the receivables. The factor firms came in and shut the place down. They started seizing funds and collateral and everything else. So this is the other part of the story. That's the other, what you said, they don't have the means. Businesses are getting to the point where they don't really have any other option. And in order to try to stave off bankruptcy, they're appealing to all of these other alternate financing schemes, which is another canary in the coal mine, late stage cycle behavior, especially when one of those blows off as spectacularly as First Brands did. And so it's, okay, First Brands factoring receivables, liquidity starved firms appealing to these less than ideal alternatives. You got Tricolor over here, subprime auto business, that kind of, maybe there's some fraud there, but maybe there's something else going on. And it's enough that people, like the article said, it's enough that people are saying, whoa, let's stop here and take stock. And I say that, Paul pun intended. Let's take stock of what's going on and see where we really are. And let's actually, while we're doing that, let's be honest and not call this a resilient consumer economy, because we all know that's crap. It's not a resilient consumer economy. Let's be honest about where things stand, and then try to model and put together and extrapolate, if we are actually here, which is in a troubling state, where do we go from here if we're already in a troubling state, and what does that do to the credit markets? And then the bigger picture terms is there enough here that it leads to the same sort of deflationary disorder that we've seen before, maybe even to a greater extent? So not only are we trying to take stock of where things are, we're trying to get a sense of how widespread this is, how big of a problem this will be overall. I think that's why the stock market is saying, hold up here, because there's a lot of different stories and dimensions that we really need to get a handle on. And up until just recently, nobody cared. Everybody would say, hey, economy's great. We don't have to worry about all that stuff. And so that's the point that we're making here, is that we're finally at the point, late stage cycle behavior, where even the people who are willing to ignore and overlook everything are saying, okay, now we need to start taking things more seriously.